treat. We're going to be speaking with Victor Haghani again. I'll do a little bit of talking here for the first little bit to explain, just for those of you who don't know who Victor is, and then the ambitious topic length that I hope to get in front of, but we'll definitely cover a few topics right off the bat because it's a real treat to have someone like this that we get to chat to. Really, someone who has a remarkable career spanning decades in quantitative finance, investment strategy. Best known, probably, or most famously known, I would say, for long-term capital management, early modern arbitrage trading. But through that, has done extensive research, really focusing on risk, efficient portfolio construction, behavioral finance, you name it. Today, Victor Haghani is the founder and chief investment officer over at Elm Wealth. And once again, this is a low-cost investment solution. We're going to be talking about something that just came out regarding Elm Market Navigator. That's important, their ETF. So we'll definitely get into that one. You'll remember my first original discussion with Victor was about the book, The Missing Billionaires. It was a fascinating topic. We might leave that one there, but I urge you to go buy the book because there's so much information in that. And for those that love the high risk that we do in some of this mining and whatnot, this you need to know as well for your entire portfolio net worth of the true understanding of the reward you're getting and the risk you're taking, and how you should be getting you be properly paid for that, really, essentially, and attributing the right resources to it. On top of that, big news as well. As I mentioned, they do a lot of research, a lot of work there as well, and they just published, and they recently won, I think you get the award in another month or so, the 2024 Harry Markowitz Award for their winning paper talking about overnight drift. We'll get into that. This is going to be a real eye-opener for a lot of people. It's probably going to upset a lot of people as well, but but it's fascinating. And if we have time, I also urge people to go look, because it flows into that. There is a clip from your old alma mater where you did a speech at London School of Economics with a lecture, Why I Stopped Picking Stocks. And it's a lot of fun too, because it talks about you and your mom. You describe exactly, a large part of what we're going to talk about, but in the conversation with your mom. And I think it's a really nice video to see as well. So I encourage people to look at that. And if we get time, we're going to look at the crystal ball challenge, because I find that one fascinating too. So after all that, that's enough of me talking. Hello, Victor. It's great to have you.
Great to be back, Andrew. Really happy to be here. Thank you.
So let's jump in. Let's jump in and just remind people what it is exactly you guys do with Elm Wealth, and then we'll try to transition quickly into this award that you've received.
Sure, great. So Elm Wealth, we're a wealth advisor. We're based in Philadelphia, although I'm sitting in Jackson Hole, Wyoming right now, but my two partners and our staff are all in Philadelphia. And we're a low-cost wealth manager. We charge 12 basis points for what we do, helping clients to build portfolios of low-cost ETFs, and we manage them in this process that we call dynamic index investing. We use low-cost index funds, and we change the asset allocation over time. While we believe in passive investing when it comes to building stock portfolios, we think that asset allocation has to be an active process of deciding how much equities to own based on expected return and risk of equities and fixed income relative to each other. So that's what we do. We've been around for 13 years. We manage about $2 billion of assets, and we do a lot of research and writing. That's really our way of trying to connect and help people. And, that's our business. We have most of our clients are U.S. clients. We also have some non-U.S. clients. And, as you mentioned, we recently launched an ETF called the Elm Market Navigator Fund, ticker ELM.
Yeah, that was one of the larger ETFs put together. 376 million, was it?
Yes, yeah. We think it's the largest new ETF that's not a conversion of a 40 Act mutual fund. There's a few of those, but from anything excluding conversions of pre-existing mutual funds, it's the largest ETF launch, and it came from a legacy private fund that we've been running for the last 13 years. So it has a pretty long track record, as well.
this makes it a lot easier for anyone who's watching as well. I mean, it's right there. They can go pick it up. They can go buy it. Instead of having to go through any kind of process of private fund investing.
Right. Yep. Absolutely.
And I love the because I always like to talk in two different kind of breadths. And we have people that are trying to make a ton of money and they're looking at junior bond stocks and they're looking at juniors, hoping for asymmetric gains. But then there's, of course, the other side, which is people who have made a lot of money. And people don't realize that once you've made a lot of money, there's almost maybe not equally amount of fear, but there's a lot of fear then of, I don't want to lose that money. And I also don't want it to evaporate, disintegrate over time due to, like, as we see, inflation, cost of trading, cost of business. Is once you have it, there's this pressure of, oh my goodness, now what do I do? Because I have a lot of assets. It's a very different mindset. And both of those mindsets exceptionally well.
Yeah. When we wrote our book, The Missing Billionaires, A Guide to Better Financial Decisions, we thought about a different title for it. We were thinking about titling it, no one should get rich twice. but we thought The Missing Billionaires was a better title. But, I think that's right. I mean, that, we believe that no one should get rich twice. And, but, there are lots and lots of cases where that happens because people have not been able to hold on to it the first time. And, that one of the things we talk about in the book is something that my dad told me a long time ago, which is that he said it's more difficult to hold on to wealth than it is to generate wealth. And I never really thought that was true until I got more like his age when he was telling me about it. And, with all that I've seen, I do think that there's a lot of truth in that. I mean, one of the reasons for it is, to make money is usually a relatively short window of being successful and doing well. Whereas maintaining wealth, is a multi-decade process that requires, patience and dealing with boredom and all of those things. So, they're very different skills and challenges.
And certainly very different from when you're at a younger age and you're only interested in growth. You're like, no, I just want growth. Let's go. I want the high octane. I want lots of fun. I want it to be dynamic. I want to be exciting rather than, let's think of this as a 30-year strategy. And I know if I'm 22 and someone says, let's look at this as a 30-year strategy, I'm like, no, let's look 3 weeks out. 3 months out. That's it. So it is, and it's great because you've spent your life with this acute study of that risk and reward. I mean, essentially, that curve, and to truly understand it and from both those angles, so that when clients come to you and have some money, it opens up a whole new world of, well, now I could put my money anywhere, and the strategy that you made it with to get there, that you could end up in 13 different venture cap hedge fund type things, and boom, within 2 years it's gone.
Yes. Yeah. True.
So let's kind of morph into this study then. This still working on the night shift. I think you have it as part of your blog on the website. Tell us where this idea came about when you look at. And maybe let's take another step back. Explain overnight drift for a lot of people, and then these meme stocks, Bitcoin, these really high flyer, high volatile stocks. What made you even kind of come to even think? I wonder if there's any if there is something happening here. Like where did the idea come up?
So so we read about it. So other researchers. This is a topic that's. I think that it's a topic that has attracted research for at least the last 10 years. And so other researchers have noticed, particularly they started noticing it in the S&P 500. So if you go back 30 years from today, you could see the first chart there in this document. If you go back 30 years, it turns out that the S&P 500 has given you like a 20x return on your money, right? Like $1 invested in the S&P 30 years ago has grown to $20 today, including reinvested dividends. Now, somebody noticed that actually, if you only held the S&P 500 from the opening of the stock market at 9:15 Eastern time until the close at 4 o'clock, where most of the trading is happening and actually most of the volatility is happening, that your dollar would have only turned into $1.20 over the last 30 years. So instead of turning into most of the $20, it basically you basically just broke even and wound up at roughly the $1 you started with. But if you had invested, if you had bought, if every day you had bought at the close at 4 o'clock and sold at 9:15 in the morning opening auction of the stock market, your dollar would have grown into like $18. So almost all of the growth happened over the last 30 years happened when the market was closed. And again, you can look at the variability of how variable was the market during the daytime versus the nighttime. And the market was more volatile in the daytime. So if you were thinking about a risk explanation, that doesn't explain it. And so, it's rather mysterious. And a number of researchers have written papers trying to explain or provide answers to why this phenomenon has existed. And so we decided to take a closer look at it ourselves. And what we did, again, it wasn't the first time that people had done this, but what we did is we took a look at the individual stocks. So instead of looking just at the market aggregate, as most researchers had done up until then, we took a dive into individual stocks. And when you look at individual stocks, with certain individual stocks, the effects are even much, much more dramatic than what's happening at the index level. So in this document on our website, we look at the last 5 years, and we look at NVIDIA and Tesla and Advanced Micro and a few others. And the results are incredible. Like, for instance, with Tesla, $1 would have grown into $6, if you had just invested 5 years ago and held it the whole time. But you would have actually lost 40 cents in the daytime, and your dollar would have grown into $10 at the nighttime. So if you look at that, the daytime and the nighttime, and multiply those together, that gives you the full outcome. And NVIDIA is a similar kind of story, and others that we show in the document, are even more dramatic. Like look at this ARK ETF, the ARK Innovation ETF run by Cathie Wood.
Yeah.
You basically, over the last 5 years, you kind of broke even if you just bought it and held it for 5 years. But if you only held it in the daytime, you would have lost 70% of your money. And with advanced micro devices, you would have lost 50% of your money in the daytime, but made 4 times your money in the night. So these are really unusual, weird things. And we just started to wonder, like, could it be that it's somehow the stocks that retail investors are most attracted to, where we see this phenomenon? I mean, look at MicroStrategy as an incredible case. You lost 40 cents, but you made 30 times your money at the nighttime or during the night. And so we just to test this out, we tried to look at stocks popular with retail, and we found, yes, these stocks that are the most popular with retail have the biggest overnight drift in their returns. And for this short note that we wrote, we just asked ChatGPT today or last week, what are the most popular stocks with retail? We came up with this list of about 25 names. And in 24 out of the 25 names, there was a really pronounced overnight drift relative to daytime, in almost all of them except for just one. And so this is what we've written about. We won this award for the research. And, what we think is, I think that there's, the natural first reaction that people have in digesting this research is, wow, maybe I should just start trading stocks in the nighttime, and buy them at the close and sell them in the morning. And, certainly, we're sure that there are some people that are doing that or trying to do that. What you have to realize is that, there's so much turnover in this strategy that it's really hard to eke out a profit, even if the effect continues to exist going forward, even though there's been so much written about it, which might dampen things somewhat, making more people get involved in it a bit. But the transactions cost can easily eat away all of that benefit, or at least bring it down to a more normal kind of level of alpha. But what we think is really the main takeaway that people should have from this is like, wow, if I'm a day trader, an active day trader, in general, I'm going to be buying in the morning and selling in the afternoon, because day traders tend to have a long bias. And if you're going to trade in the day, you've got to first buy and then sell. And it's like, wow, I didn't even know that this effect was out there. And, it's like, here I am, like just sort of hemorrhaging returns, which other people are somehow making. And maybe it's something that people weren't even aware of. So I think it's a real cautionary bit of evidence about, really being actively trading in the marketplace. I'm sad to say.
No, because I mean it had its flurry in the 2000s. I remember everyone was I'm going to day trade, but it's popped back a lot ever since COVID, where everyone's like, and even taking crypto out, they're looking at these other stocks and going, wait, I think I have an edge, or I think I got. And I always liken people that, okay, like what is your edge then? Because I like sports analogies. It's like, because you're going to the Olympics or you're going to the NBA. So what's your edge over LeBron James? It's like,
no, absolutely. Absolutely. Yeah. And look at that one, the Grayscale Bitcoin Trust, which happens to be around for a while. I mean, it's insane, right? You from 5 years ago, it's like you lost 90% of your money in the daytime, and you made, I don't know, I forget what the number is. You made 20x in the nighttime. And it's like, wow, that's just amazing that it's, you made 60x in the nighttime and you lost 90% in the daytime with the Grayscale Bitcoin Trust. And it's like, wow, these are the, people trading Bitcoin, and like Bitcoin is the worst, and really, when you look at these meme stocks like GameStop, some of these meme stocks like AMC, it's like you lost 99% of your money in the daytime and would have made a ton of money in the nighttime. And it's just really just seems too connected to attention stocks, meme stocks, retail stocks, stocks that have a huge amount of options, single stock options volume. All of those seem to be indicators of which stocks have the biggest overnight drift. And of course, there are some stocks, some real dogs, I guess, that that actually have it the opposite way around. They make money in the daytime and they lose money in the nighttime. So those are the sort of the anti-attention stocks in a way. So there are some of those too, but it tends to be more of a positive effect than a negative effect in the other direction.
So is it, and tell me if I'm barking up the wrong tree here, is that, say with these kind of meme stocks, is that we have to have a healthy young Reddit crowd that's buying retail during the day, but that there's then a bit of an advantage either with algorithmic trading or maybe dark pools or whatever? Is that kind of like that they are able to access products that can trade at an institutional level or a hedge fund level that I'm not available to? Is there any of that? Is that what you found, or is it just no? It's.
Well, I think that makes sense. Where somebody is kind of making this return that's being left on the table by these people, and whether it's being earned really directly by quantitative trading pools, or whether it's one of the many different things that these quantitative trading pools are stringing together and layering together that make money. But this return deficit has to be made by somebody. And I would say that the most likely candidate are these quantitative funds that just seem to be taking money out of the market, in a relatively risk-free way. I mean, you just hear about some of these quant funds, that are that never have a losing day, or that have one losing day per year. Maybe it's incredible, right? I mean, if you can make money on almost on 200 out of 250 of the trading days in the year, you've just got some incredible money machine. And I think that's where some of this return is finding its way.
But it's not, it's not outlandish to say as well. Well, someone says, well, I don't, clear my trades every day. A lot of people would. A lot of people be like, no. If I'm trading and I want to buy this, and at the end of the day, most likely, like I want to clear the trade. It was either a winning day or it was a losing day. That isn't unheard of as well. Beyond just the academic pursuit of seeing that this state or difference exists, and it's such a wide gap. Like it isn't just a statistical anomaly. It's like it's huge.
Yeah. No, really, absolutely. Yeah.
So, what's the overall takeaway then because of course, there's people going to be like, oh, I'm just going to trade after hours. And they're going to look at your list of stocks and go, I'm going to start buying those, which is definitely not what you're saying.
No, it's really not what we're saying. I mean, I think really the takeaway is that, this, frenetic trading is hazardous to your wealth. That's, kind of from the title of an old paper by what are they? Oh gosh, I'm blanking on their names. These California professors, Odin and anyway, these academics from I think Berkeley and UCLA wrote a great paper like maybe 20 years ago where they had Schwab retail trading data, and they showed that active retail traders really did poorly. The more active they were, the more they underperformed the market.
And this is where your strategy comes into play very well, and with the launch of the ETF, because what you're saying is, this is an educational way to kind of show people what your solution is. That here's the issue, here's the problem. You might think it's over here that you should be trading and doing it after. It's not. You should be leaving it alone. You don't have an algorithmic trading platform unless you created one. But if you have, then you're already working at a hedge fund. So you don't.
Yeah.
You're saying we have an approach that, and we talked about this before. It's not just the investment itself, but it's the bet size, it's the allocation size that it is equally as important, which is also fascinating.
Yeah, absolutely. That's one of the things we say is it's not enough to be able to find investments that have a good positive expected return, but you also need to size them appropriately, because if you size them too big or too small, then if you size them too big, you can go bankrupt. If you size them too small, you're not getting what you should. You're leaving a lot on the table. So sizing is really important. And as we say, there's really no such thing, in our opinion, as passive asset allocation. That asset allocation always is always and everywhere an active decision where you're thinking about, how much risk do I want to take? What's the return? How much equities do I want to own? How much fixed income? That you can't just say, like with passive stock selection, you can say, yeah, I'm going to own the market cap weighted amount of each of these different 1,000 stocks. That, there's a lot of reasons why that's a sensible thing to do. I mean, it may not be absolutely optimal, but it's close. It's a good thing to do if you can do that at a very low cost. But then if you take it to the next level and say, okay, so now I've decided I'm going to invest in a global market cap weighted stock index fund or a US one, whatever, you'd make that decision. And now you say, okay, well, now I want to decide how much should I have of equities and fixed income. And I say, well, there's $100 trillion of equities in the world of market cap, and there's $500 trillion of fixed income. So I'm just going to have 16% of my money in equities and 84% in fixed income. And it's like, wait, that doesn't make sense. You need to think. I mean, if you did that, you would say, gosh, that portfolio has such a low amount of risk that I would like to have more of it. And then you would lever it up. Well, if you're levering it up, now you're long and short fixed income. So just make the fixed income less, if you have a financing friction at all. And so, I think that's really how we think about how individuals should invest. And we try to help them invest in that way in a pretty simple, transparent, rules-based manner.
And it's a real honor to win this award too. Was that on your radar at all? Or was it just came out of nowhere?
Totally came out of nowhere. And, we were really happy when we won the award. And then somebody said, wow, you should see who was number 2 and number 3. And number two and number three were these two academics that we respect tremendously, Doug Breeden and Bob Jarrow from Cornell. And we were like, oh my goodness, this is unbelievable. Because usually practitioners don't get these kinds of awards in general. Yeah. So we were like, we were just unbelievably pleased and surprised, and we're still smiling, even though it's been a couple weeks now.
That's what's so unique about it, is the fact that it's academia it's blended into the real world of application. Like, you're using this is a strategy that you're sharing kind of at the same time, and that you don't see as much of that bleeding into both. One's often theory, we're teaching you something, and then you'll practically apply it a different way or whatnot. But this is practical application, and that is quite unique.
Yeah, no, we're very grateful and appreciative. Yes, absolutely. I mean, sometimes when you're submitting an article, a research piece to a journal like Journal of Investment Management or Journal of Portfolio Management, the editors are like, listen, this has got to be in this format, and this has got to be like this, and whatever, and this is how your references have to be, and you're like sort of pulling your hair out, or I would if I had any hair, but it's all worth it when something like this happens. So really, really grateful and appreciative for the journal publishing our piece and then giving us a chance to win the award too is terrific.
And that's in a couple of weeks in California?
Yeah, in Santa Clara. Yeah, I hope I can make it there. It's a beautiful spot. Yeah.
Yeah. So that's so it's wonderful. It's beautiful. We've got time. Let's talk, because it's the same topic, and and this is one of my favorite ones because it's easy for anyone to understand, and it's the crystal ball challenge. And you've got this right on your website, so I encourage anyone, you can go find it. It's very easy. And this is designed to assess effectively how you could leverage knowledge of new profits from financial markets. It's a really good way for people to think. If you have access to information early, you've got a crystal ball. Most people think, oh, well, I'm going to make a fortune. I'm going to make, that's just what you think. If I know what the news is tomorrow, or someone gives me a hot stock tip, that I'm gonna make a ton of money. And I'll let you go from there and tell us what you found with the crystal ball challenge, because that's another fascinating one that's counterintuitive to what people think.
Yeah, well, it was a really fun project, and it had been percolating with us for years. I think the first, it's kind of a general topic that we're interested in. It's in our wheelhouse. But the whole thing kind of started with a tweet from Nassim Taleb some years ago, where he made a tweet and he said, if you gave most investors tomorrow's newspaper today, most of them would go bankrupt in a year. And I think what he was getting at is that markets are unpredictable, and people think that the news is just super valuable in terms of telling you what the market's going to do. And so we were like, wow, that would be so fun to test that. And so that's really what we decided to do, taking that idea from him and putting it into an experiment. So we created a game where players are given the newspaper, effectively given the front page of the Wall Street Journal from the future, and they can make trades in stocks and bonds just before that news happens. So basically, you get the front page of the Wall Street Journal for Wednesday, and you can put trades on for Monday night's close, and then the trades come off at Tuesday night's close. So the news that's in the Wednesday newspaper is all the news from Tuesday. And so, you should be able to make money by trading on that. Now we black out, as you can see there, where it says that bonds or stocks were up or down, because that would make it too easy. That's not what, that would really be like shooting fish in a barrel. But here it's like, okay, what was the employment report? What did the Fed say? What was other news going on? What did oil do? We leave a bunch of things in. What did crypto do in more recent years? And we allow people to have 15 of these different days and then be able to do the trades. And, we've had tens of thousands of people play the game so far. It's been a little bit, I think it's been a year and a half or so since we published it. And to begin with, we had people playing it for money. We went around different universities and had masters in finance students play the game for money. so that we could get like in a more proctored, controlled environment what the results would be. And I think what we thought might be the case turned out to be the case, which is that people did not do very well. It wasn't that most of the people did not go bankrupt, but people did rather poorly altogether. And certainly people on average didn't make a lot of money. So we wrote about it, and you can find the article on our website as well as the game. And again, I think it's just an incredibly kind of cautionary bit of evidence about really being active traders and using leverage and so on. Now, one of the things that was really interesting that somebody suggested that we do after we got going is they said, why don't you try to go to some really successful traders, like older people at macro hedge funds that had a really good track record, and see how they would do. Maybe they would do well, And yeah. We did. We went to a couple of macro traders that we knew, that we were friends with, and asked them to play the game. And sure enough, they did pretty well. They sized their bets well. They could recognize when was a good time to make a big bet versus not bet at all. They were very selective. Most people that played the game just thought, well, gosh, I'm getting the newspaper, I better do a trade. And after all, I've got the newspaper. But there were a lot of times when the news was ambiguous. Also, it turned out that trading bonds was easier than trading stocks. With bonds, the news tends to be less ambiguous. High growth. Like you get something that's like a strong employment report. For stocks, it's like, well, that could be good for the economy. The economy is doing well. Maybe stocks should go up, or maybe it means there's going to be inflation and higher interest rates, or stocks should go down. But with bonds, a strong employment report means bonds are going to go down, or more likely to. But most people really were focused on trading stocks and not bonds, which we also thought was interesting. So lots of interesting little tidbits in there. It's a really fun game to play and test your skill and sizing and selectivity and patience. So yeah, thanks for mentioning it, Andrew. Appreciate it.
Well, it's one of the things on the site, and it's when you're offering something like that you get to learn, and it's a real eye opener, because most people assume that if they're getting the information ahead of time that solves the problem right there and then.
Yeah.
I do know in the sector I'm in and the space we're in, we hear it all the time, maybe for a different reason, but people, it's that sell the news. If you find out, well, there's good assays coming out tomorrow, the stock might go down. So, or it might go up a little bit and then it crashes right down. And there's a myriad of reasons for it, from anything from, a big fund wants to execute 10% of its holdings. Who knows? Whatever it happens to be. But there's a million reasons why it could, that people just think, oh, it's good news, it should just go up. That's not the case. And it's interesting to see that's in every facet of the market. But it also reminds people that I always kind of think, if you think you've got, you think I get it, I understand it, maybe you don't. Pause for a minute, maybe, because people have spent their entire lives and careers studying this. So if I'm at home and I go, aha, okay, I've got it. No, probably I don't. I like it, explaining to people as well, is that if they look at anything like this that passionately, is that whether it's, say, you're an athlete and you can kind of score your progress relative to the world and how you're doing, and you're expressing yourself in a physical way, this is the same way as you're kind of saying, here's a viewpoint or a worldview I've got, this is how I analyze and look at the world from an economic standpoint. Is it factually true? And it's to be able to challenge yourself continuously over a period of time. It's challenging because most people just assume something they learned in university, and they go, that's it. Well, now I go into my career, end of story. And this is, markets are so dynamic and fluid that to keep up, especially now with, algorithmic trading and we're going to get into quantum computing and AI and everything else. I mean, the pace at which things are changing is remarkable.
Yeah. No, it's just, I think, in some ways that, just thinking about who is on the other side of the trades that you're doing is very, should be very humbling and very scary for most people. When we know that, Citadel and D.E. Shaw and Jane Street and all these guys and Rentec, that they're taking, that in aggregate, I mean, maybe they're taking $100 billion out of the market every year in a relatively low risk manner. And the chances are, if you're doing something, given how much trading activity they have, et cetera, that they're on the other side of what you're doing, and so, in the chance that you're like at the top of the food chain, right, is that you're really that in the arms race that's out there, it's just so hard, at a short horizon, maybe at a very long horizon, sure, that's a little bit different. And investing in stocks is investing in the broad market is a very long horizon process. But like if you're trying to really accumulate wealth through trading, 0-day to expiration options or things like that, it's really just so stacked against you, that there's worse things that you could do, like taking that money and putting it into slot machines in Las Vegas. But there's not many things that are much worse that you could do.
Yeah.
Yeah.
And that is important to know, because once again, it's I think we originally talked about it too, is I get excited when you see a lot of younger people who are excited about the markets. And this is, I say, the good side of, say crypto or some of the meme stocks. You go, okay, we've got a lot of people who are interested. Now they might be interested for the wrong reason, but they're putting a little bit of knowledge into an interest, and it's kind of like, well, how can we harness that? If you have a real fascination, encourage them to go down one path, or to say, listen, it's fun to have a hobby with it, but if you're really you're poking a bear to a large extent if you're going to play with it. The level of knowledge that you have to accumulate, once again, is not unlike just showing up at a court and saying, put me in, coach. I've played basketball one weekend. Put me into the final. It's like, what? Yeah. That's what it's.
But look, the markets really are just absolutely fascinating. And as we try to think about what's happening in the world, signals, understanding markets and looking at signals from markets is, incredibly valuable. So I think that it's wonderful that people are interested with markets and really want to follow and learn and all of that. But that doesn't mean that you have to, that doesn't mean that you have to be a day trader. I mean, I am absolutely fascinated, excited. I love to read and learn and think about what's happening and all of that. But I don't trade individual stocks. I don't do short-term trading. I don't trade individual stocks at all, and haven't for quite a long time. But I still am really fascinated. So I think that you can love the movies, but it doesn't mean you have to try to make a movie, whatever. Yes. I think that there's a lot of endless that we can be endlessly fascinated with the markets. Like, I mean, this whole crypto thing, for me, let's say it's been 40 years or so, or a little bit more than 40 years that I've been involved in markets. It's like the most amazing story. I love to read about it. I love to read people like Matt Levine writing about it. I love these stories. It's just terrific stimulation, entertainment, and learning for me. But doesn't mean that I have to invest or trade crypto to really enjoy seeing it and watching it and learning about it.
And also, this certainly isn't financial advice, but it's like 95% or more of your wealth or asset or money should be very stringently viewed with a very big risk capital in mind. And if you have that betting streak where you're like, I can take 2% and throw it at that, that's be that vigilant, be that dedicated to that, because like I said before at the beginning, one of the biggest things is your acute knowledge of that risk to reward and risk allocation. That's critical. Like once you start losing money, say you had a couple wins, once you start losing, that's like it's losing at 50% is not the same as making 50%.
Yeah. And the frictions. I mean, that the toll keepers and the other people in the market are just taking so much out. Like, I was thinking last night about the story. I think what a huge story this thing was. What's it called? The exchange called Bybit, right? That's the second biggest crypto exchange. And they had $1.4 billion, heisted out of there, right?
Yes.
And it's like, wow, to me, the biggest part of that story is they said, no worries, we're making a couple $1 billion a year from all the punters on our exchange. We're going to just keep in business and we're just going to pay this back to everybody so we stay in business. And then, everybody else that's in the industry is like, whoa, we can't let anything bad happen. And so you have these other guys that are just extracting huge amounts of money from the market, just lending these guys money because heaven forbid that, they fail or people get worried about it or whatever. And I'm like, wow, how should that make you feel as a customer of Bybit? That first of all, there's some amount of hack. If the hack had been $100 billion instead of 1.4, then your money was gone, your wealth was gone. So A, they're vulnerable, but B, they're like taking so much money from you that they can just say, here you go, don't worry about it. I mean, I just thought that was like, an incredible story there. And, it's like, I also started thinking to myself, like all these guys, I bet these Bybit guys, right? Like think about how much money, if they're making $1.4 billion or more per year, right? Like they've accumulated $10 billion, and I was thinking to myself, like, what are the Bybit guys doing with their $10 billion? Do they have it in treasury bills? And I said, I bet you that they don't. I bet they've got it in crypto. And I bet that the guys at Tether, these guys are making $5 billion risk-free per year from having Tether, right? What are they doing with their $5 billion? Are they putting it in treasury bills? And I was like, no, I bet that they are in crypto with it, that they're putting it in crypto, because they believe in it and all that. But if you think about it, right, like all of these guys that are extracting money from this crypto business, right, they should all be short crypto, but they're all long crypto. And I was thinking to myself, like at some point they're going to wake up and say, wait a second, if crypto prices stay high, that's wonderful for us. But what's going to kill the golden goose is if crypto prices go down. So we should hedge our businesses by being short crypto, not long it. And, at some point, like I just think that, I was just thinking about it. I don't know. You didn't ask me. I don't know why I'm telling you this. I don't know. I think the viewers, but it just was like, wow, this is so bizarre, and I know that some of the big trading houses, like you have to own crypto to be trading it also, right? Like if you're going to make markets in Solana, you kind of need to own some Solana to post it on the exchanges and stuff, right? Or if you're going to be, market making in ETH or whatever, you need to own some ETH. And I was like, wow, these market making guys are making so much money that they're like happy to own this stuff, but really, they should be short. They should be short this stuff, and that would really lead to a very different, setup, I think, of where we are right now. But anyway, just was thinking about that a little bit.
No, that's interesting. On another note, I didn't study enough on this either, but maybe you've heard about this too. I just saw something on X or Twitter yesterday about like a Bitcoin bond. So
no, I haven't seen a Bitcoin bond. No.
Let's not even get into that though, because that was a attempt to 10% of we'll put kind of to clear up the U.S. deficit. We're going to create a Bitcoin bond, and I thought, oh boy, holy smokes. That's another conversation then.
Well, MicroStrategy is issuing a ton of bonds, and in some sense, they're, certainly have some exposure. There's some exposure to crypto or to Bitcoin. If you're buying a MicroStrategy bond that's paying you 8%, that 8%, the reason you're getting 8% instead of 4% is, that you're taking some Bitcoin risk in there, of some nature. Yeah.
Well, this has been fascinating. I could keep you all day, but I won't. But I'm so glad to see so much that happened, early on in the year for you. And I encourage people to go check out, obviously get the book, but go check out that LSE lecture because it is great. And you make it very accessible. And I think that's what's important for people to understand is that it isn't. You can certainly go and lecture at the highest level of quantitative finance. We'll lose all of our subscribers, but I appreciate this level of conversation. It's a real eye opener for people, and we always like to encourage people as well. Is that what I do fits into a very narrow, portion of someone's life, but they need to be looking at risk all the time. I talk about risk all the time. Mine's way up here. But that is critical to understanding, and whether you want to accept that risk or not, that's entirely up to you. And you spent your entire life dedicated to understanding that risk, and whether or not, listen, and sometimes having to tell someone you're taking a lot of risk and you're not getting paid for it.
Yeah, that's a good point. Great. Well, thanks so much, Andrew. Great being on this show, and wonderful connecting with some of your viewers. So looking forward to doing it again before long as well.
Excellent, and congratulations. Have a great time out in California getting the award, and we're going to be watching as well to see how the ETF is doing. And once again, everyone, you can go find that ETF. It's trading, it's live, and off to a great start. And we thank you so much, Victor. It's great to have someone to help educate and share some realities of what the markets are like as well. So once again, enjoy the rest of your day. I really appreciate it, and thanks so much.
Thank you, Andrew. Same to you.